What's crackin'? Did you know that chickens can sense a storm coming before humans can? Yeah, they get all jittery, clucking and running for cover way before the first raindrop falls. It's like they've got tiny weather radars hidden in those fluffy feathers. Now humans, we've got our own version of that. It's called constantly freaking out about a recession. Turn on the news, scroll through your phone. Recession is coming. Brace for the worst. Hide your eggs. But why does it seem like we're always hearing about a recession? Are we actually in one? Is one around the corner? Or are we just a bunch of nervous chickens clucking at every cloud? Imagine the economy as one gigantic chicken farm. The farmers are businesses. The chickens are workers. The eggs, that's all the stuff we produce. Clothes, phones, pizzas. When times are good, the farm is booming. Chickens are laying eggs like crazy. Farmers are selling them at the market. And everybody's strutting around with brand new sunglasses and fancy coop upgrades. But sometimes, the farm hits a rough patch. Maybe the weather's bad. Maybe the price of chicken feed goes up. Maybe the farmers get into a ridiculous argument about whether to build a giant chicken roller coaster instead of fixing the broken egg sorting machine. Whatever it is, the farm slows down. Fewer eggs, less corn to go around, some chickens get laid off, some farmers close up shop. That, my friend, is a recession, when the whole farm shrinks for a while instead of growing. In human terms, a recession usually means the economy is shrinking for at least a few months. Less buying, less selling, more people losing jobs, more businesses tightening their belts. Sounds simple, right? But here's the thing. Spotting a recession in real time is like trying to tell if a chicken is sick just by looking at its mood. One minute it's clucking happily, the next it's napping in the sun, and you're standing there like, should I be worried? Economists try to track all kinds of signals. Stuff like GDP, that's the total egg output, unemployment numbers, consumer spending, business investment. But those numbers are messy. They lag behind real life. They get revised. It's like checking yesterday's weather report to figure out if you need an umbrella today. So people start guessing. They look at the clouds gathering over the farm and say, I smell a storm coming. Or they see one chicken sneeze and scream, bird flu, shut it down. And that's why you hear about recessions constantly, even when nothing's happened yet. Because humans hate uncertainty. We'd rather panic early and be wrong than stay calm and be caught off guard. It's survival instincts baked into our brains since caveman times. Better to hear a rustle in the bushes and assume it's a saber-toothed chicken than ignore it and get eaten. And then you've got the media. Markets tumble on recession fears. Sounds way more exciting than things mostly fine, mildly wobbly. Fear sells, it gets clicks, it gets eyeballs. It gets people tuning in to hear the latest Chicken Little story, and once the headlines start clucking, businesses and regular people start acting differently too. If you think a recession is coming, you might cancel that big vacation. You might save a little more and spend a little less. You might not buy that fifth chicken hat you had your eye on. Businesses do the same. They might delay opening that new store. They might cut costs. And here's the twist. All that pulling back, it can actually cause a recession. Yep, just like enough chickens freaking out can cause a full-blown farm stampede, even if there's no fox in sight. Economists call it a self-fulfilling prophecy. If enough people believe a storm is coming, they act like a storm is coming. And suddenly, boom, storm. Pretty clucking ironic, right? Now, add in the fact that the economy naturally moves in cycles, kind of like seasons on the farm. You have periods of growth, good harvests, lots of eggs, farmers throwing barn dances. Then you have slowdowns, fewer eggs, more cautious spending, chickens grumbling about how eggs just aren't what they used to be. These ups and downs are normal. They're part of the farm's rhythm. But because we can't predict exactly when the next slow season will hit or how bad it will be, we get stuck in this endless loop of fear and gossip. And even when there is a real recession, it's not always the apocalyptic doomfest people imagine. Sometimes it's a short, shallow dip, like a chicken stumbling over a pebble but quickly getting back up and chasing a butterfly. Other times it's deeper and rougher, like tripping over a rock, rolling down a hill and landing in a mud puddle. But either way, economies tend to recover. Just like the farm bounces back after a rainy season, chickens get back to laying eggs. Farmers fix up the coops. Life goes on. Still, when you're stuck in the muddy, gloomy middle part, it's easy to forget that recovery is even happening. And right now, every little cluck of bad news gets amplified by media, by businesses, by random Facebook posts, until it feels like a full-blown feather tornado. But is it really the end of the farm as we know it? Or just a nervous flock overreacting to a passing cloud? Well, the answer depends on a few key things. First up, how strong is the farm underneath all the noise? If the chickens are healthy, the barns are sturdy, the fields are full of fresh corn, and the farmers aren't spending all their time building chicken catapults for TikTok videos, then a few storm clouds aren't the end of the world. There might be a slowdown, fewer barn dances, slightly smaller egg parties, but the farm keeps running. The rhythm stumbles but doesn't stop. In economy terms, if businesses are still producing, if people still have jobs, if banks aren't handing out loans like free samples at a state fair, then even if a recession sneaks in, it usually ends up mild and manageable. More like a rainy afternoon, less like a Category 5 chicken hurricane. The second thing, how the farmers, aka the government, and the central banks react. Imagine if, when the first drop of rain fell, Farmer Bob sprinted around the farm screaming, "Everyone panic, we're all gonna die." Not helpful. Good leadership during a slowdown means calming the chickens, patching the leaks, handing out umbrellas, and making smart decisions. Even if some of those decisions aren't immediately popular, governments can lower interest rates to make borrowing cheaper. They can spend a little more money to build new stuff, bridges, coops, highways, you name it, so chickens stay busy and keep earning corn. It's like making sure every hen has a cozy corner to ride out the rainstorm, rather than standing out there getting soggy and sad. Now, sometimes the farmers get it wrong. Sometimes they wait too long, or they panic too fast, or they fight with each other about whether the emergency chicken spa is really necessary. That's when a small problem can turn into a bigger mess. Take 2008. That wasn't just a drizzle. That was a full-on batten down the hatches, the rivers flooding the barns disaster. Banks had been handing out loans to anyone with a pulse. Chickens, squirrels, imaginary friends, didn't matter. And when people couldn't pay those loans back, the entire financial system froze like a terrified rooster at a fireworks show. That recession hit hard and took years to recover from. The farm had to rebuild almost from scratch, but not every recession is like that. Fast forward to 2020, a different kind of storm hit. The pandemic shut down huge chunks of the farm overnight. Restaurants, airlines, hotels, all slammed shut like a coop door in a tornado. This time, though, the farmers acted fast. They sent out stimulus checks. They dropped interest rates. They tried to keep the chickens fed and the coops warm, even when nobody was leaving their nests. It wasn't perfect, not even close, but it stopped a complete collapse. And today? Today, it's less like a sudden lightning strike and more like a slow, uncomfortable drizzle that just won't stop. Prices went up, that's inflation. So governments started raising interest rates to cool things off. Higher rates mean borrowing money costs more. Loans for houses, cars, businesses, everything got pricier. When borrowing gets pricier, people and businesses spend less. And when spending slows down, the economy starts to lose a little bit of its egg-laying mojo. It's like the farm is still alive, but everyone's moving just a little slower. A little more, maybe I don't need that 8-foot-tall inflatable chicken after all. But, and this is important, a slowdown doesn't automatically mean a disaster. Just like not every cloudy sky turns into a thunderstorm, not every economic dip turns into a brutal, soul-crushing recession. Sometimes it's just a reset, a breather, a chance for the chickens to catch their breath before they start laying double again. So, in conclusion, you keep hearing about recessions because humans are wired to fear uncertainty. The media loves a good panic headline, and the economy is a living, breathing system that naturally goes through ups and downs, like seasons on a big old chicken farm. Sometimes a slowdown is just a sprinkle, sometimes it's a thunderstorm, but either way, panicking early usually does more harm than good. Stay calm, stay smart, and remember, no matter how loud the clucking gets, the farm finds a way to bounce back. If you want me to make other videos explaining these topics, please like and subscribe.